welcome to this very special edition we are calling India Among Emerging Markets. I'm Tanvir Gill in the Mumbai News Center. Now, as we all know, India is an emerging market. There are no two ways about it. China is also an emerging market, and so are countries like Taiwan, South Korea, Mexico, Brazil, Russia, Turkey. The list is long. An emerging market, as a classic definition of the asset class goes, has been defined as a country that is transitioning from a dictatorship to a free market-oriented economy with increasing economic freedom, gradual integration with the global marketplace, as well as other members of GEM, which is Global Emerging Markets, an expanding middle class, improving standards of living, social stability and tolerance, as well as an increase in cooperation and multilateral institutions. The EM class came into being in the early 1980s, but nearly 4 decades later, we still live with the same classification. Is it time to break up the group and differentiate between EMs? Is it time to separate an India from a China, from a Turkey? We attempt to answer why emerging markets need to be regrouped based on performance and why India has a case to carve its own identity as an investment destination. Let me put this story into context. Let me go across to my colleague Mubina Kapasi, who's collated a lot of data and compared many emerging markets, in the current space to India's macro and market performance. Mubina, take it away.
Emerging markets are certainly a scary place to be right now. Let's take a look at what exactly are the problems that's actually surmounting each and every emerging market, at least the bigger ones for now. Turkey, of course, has been at the center and the genesis of this EM crisis, if you could call it that, be it the currency crisis, the double-digit inflation, and the deteriorating relations with the United States. That investment rating, as per S&P, is currently junk for the country of Turkey. Be it China as well, which is locked in a trade war with the United States. And don't forget that all the frequent macroeconomic indicators are pointing to slowing growth. Nevertheless, still, given the fact that China does have relatively stronger repayment abilities, the investment grade for this one, as per S&P, is strong. Brazil, too, the eye is on a very tumultuous presidential elections, and S&P 4 now has given this one a below investment grade. Russia, meantime, as well, is currently at the center of the entire controversy around US elections. And of course, not to forget the high dependency on energy too. Stable investment grade is what this one has been attributed. South Africa is as well currently in the midst of a slowdown in economic growth. Speculative is what S&P is currently terming its investment as. But when you look at India, GDP growth has rebounded very strongly. Of course, there are some concerns about macroeconomics and of course the fact that we are going to be in election year, state as well as national. So that's something that you would want to watch out for India. Stable investment grade. And now the key question that we've attempted to answer is India more resilient versus the emerging market pack? This is exactly what the investment grades currently look like. India, of course, can be credited with having stable investment grade when Brazil, Turkey, South Africa have been a bit sketchy on that note. And look at the way the MSCI indices of these respective countries have moved. You'll notice that India has actually managed to outperform the indices with just about negative 0.3% growth, whereas countries like Brazil, South Africa have lost almost, in fact, in double digits. 19 and 14% is what they have lost. Let's take a look at the macros then. First up, the IMF growth forecast. India is going to continue to be the strongest economy, the fastest growing economy with 7.5%, whereas Russia, Brazil, South Africa, even the world economy for that matter, is just seen growing 4%. However, when you look at the current account deficit or surplus story, India is still could have done a bit better, just negative 1.9%, though not as much of a concern as it may be for South Africa, but still could be a bit better, like Russia, for example.
Thanks, Mubina, for helping our viewers with the background in emerging markets and India's position within the same. Now, there are 3 key questions that we're trying to answer through this discussion. Is it time to reclassify or regroup emerging markets based on macro and market performance? Will India graduate from the EM group as it becomes the 5th largest economy in the world? And thirdly, has the EM risk correlation broken down, making stronger emerging markets like India less vulnerable to an impending EM contagion? Joining me on the show right now is none other than an emerging market veteran, the man who coined BRICS, the acronym, way back in 2001. You know him well. Jim O'Neill, a former UK Treasury Minister and Chairman, Chatham House, joins us for a detailed discussion. Jim, it's great to have you on the show. Thanks very much for taking out the time to speak with me on this subject. It's been 3 to 4 decades since countries with rising per capita and potential of high growth have been classified as emerging markets, as I told my viewers. Investment decisions are based on this classification. Do you think there is merit to do a regrouping within emerging markets on the basis of performance now? Really, evaluate each country for itself?
I guess at the core of this discussion, irrelevant of whether they're called emerging markets or something individually, what one major crucial fact needs to be recognized, and that's the direction of US monetary policy. Because it's not just emerging markets that get affected. Even things like the price of gold, the price of oil in dollars, the dollar itself against the yen and the euro. So, when the Fed starts raising interest rates, it has an influence on all financial markets around the world. Now, in saying that, it also raises the question, which I think is a very genuine one in my view, as to whether that is sensible. The US economy is now less than 25% of world GDP. China is 70% the size of the US. So far this decade, China has contributed 49% of all global nominal GDP increase, more than the United States. And yet, despite all of that, the role of the dollar and US monetary policy on world financial markets is much, much bigger. And at some point in the future, which is an indirect way of leading more specifically to your question, bigger emerging nations, particularly China, but maybe India, will be able to develop their own domestic financial market to a scale and degree where it's not so dependent on what's going on in US dollar denominated financial markets. But at the moment, and despite the relative decline of the US the past 20 years, the role of the dollar and US denominated financial markets continues to be huge.
Right. So you two share the view, Jim, that countries like China and India, based on the size of their economies plus their resilience to global shocks, should be evaluated and kept aside as separate entities.
So, I mean, as I said earlier, I think it's ludicrous that China can be, in particular, can be regarded as emerging market. For a presentation I'm doing in a couple of weeks, I've worked out some numbers, one of which I've touched on. It is literally the case that since 2011, since this decade started, of all the increase in global nominal GDP, 49% of the whole global total has come from just China. How can that be classified as a traditional emerging market? I mean, it just doesn't make any sense whatsoever. America's most iconic modern company, Apple, for probably 5 years has sold more iPhones into Greater China than it has in the US. I mean, I'm pretty sure the CEO of Apple doesn't regard China as an emerging market. So it's, the way that the financial markets still behave in this way is sort of ridiculous. And it suggests to me that financial innovators are nowhere near as sophisticated or as creative as they like to pretend that or think that they are. I think the possible paths are quite straightforward. China should be regarded in many ways the same as a G7 country.
Let's take the example of Turkey, Jim. What's happened with Turkey makes many believe that the EM risk is highly correlated, comparing the current situation to the Asian crisis in 1997. Is the EM contagion risk still strong?
So first of all, I think Turkey's situation I wouldn't call it unique. I can think of many aspects of the Asian crisis, or you know, I go back a long way, as you know, the so-called tequila crisis of the very early 90s, or various emerging market crises in the 80s. And in Turkey's case, in some ways, the big question is how come it never happened years earlier? I remember when I was making a documentary for the BBC in 2014 about the next countries after the BRICS, including Turkey. I went to Turkey, Indonesia, Nigeria, and Mexico. And everybody I spoke to in Turkey said they expected there to be a crisis about Turkey within the next year. And it's not happened until, what, nearly 5 years later. And I think Turkey's brought around a lot of the problems specifically on itself, because it has a very high current account deficit. And of course, its leader has taken some very isolationist policy steps, and some particularly controversial ones in terms of standard monetary and fiscal policy. So it's highly vulnerable to what's happening with US monetary policy.
Jim, has India carved a niche for itself with the equity market performance, the macro variables in the current account deficit, as well as the fiscal deficit, having more stability versus other emerging markets, plus India's investment grade being better than what other emerging markets have reported? I mean, most emerging markets in the last 2 years have been downgraded to junk status. A lot of them have. Whereas there is much talk about India's investment grade being revised higher, a notch higher at least, to lure some of the long-term investors. That, don't you think that makes it a more compelling investment case versus other EMs?
So I reflect on, I think, maybe the last interview we did. I think I mentioned that in a sort of attempt at a sort of joke that Indian equities seem to be impervious to anything going on anywhere, and that all that ever happened is Indian equity markets went up every day, irrelevant of what was going on. I guess now that isn't the case. But I think by and large, over the whole period of the BRICS story, I think the Indian markets, and here to some extent I'd include the currency, have developed more of their own life. And people have looked, and certainly I have looked at India, broadly speaking, in its own right. And as you would know, a specific unique part of that, because India's never been so exposed to international trade as many other countries. A lot of people think the Indian equity market in particular has got so-called defensive properties because of India's economy being, in theory at least, more resilient to adverse global shocks. And of course, particularly since Modi appeared on the scene, what is it now, 3.5 years ago, is it? I think that gave a further premium to India, because people believed, and to some extent that has remained, that India's embarking on a better structural path.
Jim, does that mean that the EM risk correlation is broken down, and if the region is hit by a crisis, then India will be less impacted than others?
I think it does, yeah. But I would, in that regard, I would also emphasize again something I touched on earlier, that a very important contrast to the Asian crisis. You know, the rupee, to a large degree, is a floating currency, and for the rupee to decline, albeit by 9% recently, at a time where the dollar is rising against most currencies all over the world, I don't think should be regarded as a particular source of focus. What would be potentially more worrying for India if there was some kind of rigid fixed exchange rates, which typically, if it was like the past in many other countries, might have encouraged excessive borrowing in dollars, and at some point the Indian authorities couldn't support the pegged rate, and there had to be some devaluation. That would be much more concerning. And the fact that the rupee's fallen, when the dollar's also seen a significant rise against the RMB, never mind the euro and the yen, I don't think is a big deal. If you had a declining rupee and a declining stock market and evidence of problems in the Indian bond market, then there would be a case for having concerns. But I look at, as you just described, Tanvir, all the collective performance of the Indian markets and be pretty relaxed about what's going on.
Talking about India specifically, you think a large part of the investment attractiveness for India is, and especially India's growth story, is supportive macros or stable politics?
Oh, if I knew the answer to that, I would be speaking to you, or I am speaking to you from a very nice part of the world, but I would be speaking to you from my own Caribbean island that I would have bought if I was that clever. Um, uh, I think it's obviously a combination of each of those things. My own hunch, as I touched on when I mentioned about life since Modi, I think Modi has sort of retained a little bit of a sort of magical factor, which to some degree I'm not sure is entirely justified, but linked to it, in particular, the fact that India now regularly grows its GDP at a rate faster than China. I think that gives it a degree of attraction as the strongest growing BRIC economy that otherwise wouldn't be there. So I think all those kind of things from the macro are certainly not unimportant. And I think there is some constant awareness from investors that the potential for significant micro reform, take, for example, the never-ending discussion of foreign direct investment, is always hanging over India, which makes people think that there is just such great potential out there. So I think it's a kind of combination of both. That might be because as we got through time, maybe that initial perception of Modi's policy change turned out to be too pessimistic. But it might well be, and this is why it's important, that the Indian macro economy continued to grow between 7 and 8% anyhow. The only way of really answering your question would be if we saw a period where India was growing by 10% or more, which I maintain still in theory could happen if Modi or any other leader of the country decided to more actively embrace structural reform, given the staggering demographics that India has.
Another aspect to this story is, how EMs are linked via their respective currencies. What do you make of the currency weakness in emerging markets, Asian currencies included? The rupee has fallen nearly 10% from a year-to-date perspective, but it has still more resilience given its domestic fundamentals, that it has made India stand out or look not as bad as some of the other regions. Do you feel that this weakness in the Indian rupee will be bought into, which will give India its due strength?
I remember another interview we did a couple of years ago where I said to you I thought the rupee was a great buy, and it turned out to be within a couple of days the rupee started rallying, and I was my timing was very lucky. I think in this particular case, given the debate about what the Fed's going to do, it is a bit trickier. And if for some reason we saw signs that the inflation was accelerating in the US unexpectedly, and the Fed would have to raise by more than the markets have priced, then I think you'd see the rupee decline further, irrelevant of what was going on with India's deficit. Now, assuming that isn't the case, and given how the markets have reacted to the Fed chairman's speech in Jackson Hole, i.e. sort of like a dovish reaction, and very importantly, this is very much a personal view, I do not believe there is any chance of a Trump administration achieving its goals if the dollar keeps rising. I think the rupee, probably broadly speaking, is quite attractive from a valuation perspective. And I would guess 6 months from now, the dollar's going to be weaker almost across the board against virtually every currency other than those with very bad fundamentals. Because I don't think the US can preside over a rising dollar given the economic policy ambitions it has. And at some point, I think the dollar's trend will change.
And so finally, Jim, I mean, I have to put you in the spot, right? Given all your experience in the business of investing, if you had $1 million to invest across EMs, how would you allocate that money across the region, across the asset class? And if I were to give you another $1 million to deploy in India, where would that money go?
So I look forward to getting the special delivery envelope with the $2 million from you. I actually think, given where markets are, from a medium-term perspective, so from that I mean genuinely looking out 1 to 2 years, and here, if I had $1 million that I didn't have to worry about mark to market, which of course many professional investors do, I think we've got one of the best valuation mismatches we've seen in a long, long time, possibly going back to the early noughties. And any way you look at it, the US is definitely not cheap. In fact, on most criteria, it's actually quite expensive, whether it be a CAPI or more standard valuation models. And on a relative basis, many so-called emerging markets are much, much cheaper. And so I would definitely put fresh capital more into so-called emerging markets, India included, than the US or other major advanced markets. Inside the second part of the question, I am sufficiently removed from the day-to-day and week-to-week that I don't have a strong feel for what sector would be better than other in India, but I have a growing view that the things that will make India have more lasting structural economic and social success relate to education and health. So I personally would be looking at smart investments, whether they be private opportunities or publicly quoted companies in those two areas. Because I think in order for India to sustain positive growth and help its disadvantaged people share more in this great success story of India, which, by the way, I think by the end of next year, there's got to be a chance India will become the 5th largest economy in the world. I think it needs to do more on healthcare and it needs to do more on its education. And if that's the case, then those two areas are going to be great places for financial investors as well.
Well, Jim, thanks very much for taking out the time to speak with us on this subject. Clearly, India deserves a special status within the emerging market class, and maybe as time goes by, the world will sit up and take note of India's progression as an asset class, as an investment destination within EMs. With that, thanks very much for joining the show. Hope you enjoyed it.